after the horrible experience of the lockdowns and then the government paying people not to work, paying them more not to work than the paycheck they were getting, created all these distortions. And what happened was that companies lost contact with their employees, couldn't find them again, and you had this massive distortion. That's one of the reasons why the job openings data, looked like a dot-com stock from 1999. Job openings, because companies are trying to find the employees that they used to have. And so we did have this distortion, and I could see as a business owner, you're going to be loath. You're going to be loath to let people go in fear of what happens in the next cycle. You're not going to find them again. But what's happening is that hours worked are going down.
Mhm.
And what's interesting is that it's the work week. The work week is one of the only leading indicators from something that's otherwise a lagging indicator called employment. And the work week is down 0.6% year over year, which sounds like a small number, but it isn't really. And what's happening is that companies are not firing people yet, but they're cutting their hours. And that's classic transition. Going back 70 years, when you're making the transition from expansion to contraction. And look, there's no reason to get overly passionate about this. The business cycle is the business cycle. Thank the good Lord that 85% of the time we're in an economic expansion, 15% of the time we're in recession. But recessions aren't unicorns. They're not fairy tales. They're not fantasies. They're real. But thankfully, they happen 15% of the time. The same thing with bull markets and bear markets. We're in a bull market 85% of the time historically. We're only in a bear market 15% of the time, but it behooves the economists and strategists and analysts to identify for their investors. So where exactly are we in the cycle? Well, focus on the leading indicators and focus on those relative to the coincident to lagging, because ratios are more important than levels, because ratios give you something about momentum. That's why people who follow the equity market, they look at Dow transports to utilities. They look at consumer discretionary to consumer staples. They look at value versus growth, small caps to large caps. So you're always looking at ratios because they tell you something about relative momentum. So when you're taking a look at the labor market holistically, and you're taking a look at what's happening, not with bodies, but what leads bodies. What leads bodies are hours in both directions. When you come out of a recession, you see companies aren't sure, are we really out of the recession? So you see, they don't start hiring right away. What do? They start to lengthen the work week of their existing staff. And now, but that's working the other direction. So look, I know the recession is like waiting for Godot. It's like we're waiting and we're waiting. But recessions, they're sort of like they're this odorless gas. And the next thing you know, I mean, look what happened in the last cycle when I was at Mother Merrill. Come on. In the summer, in June of 2008, the Fed shifted to a tightening bias. Richard Fisher from the Dallas Fed actually voted that meeting in June, a couple of months away from Lehman and AIG and Merrill collapsing. Everybody thought, Bear Stearns is a one-off. The housing is behind us. The consensus in the summer of 2008 was soft landing. Next thing you know, nobody had a clue that the recession, the NBER defined recession, actually started in December of 2007. So that's what I'm trying to say. Look, we had a housing collapse, house price collapse. It infected household balance sheets. Then, of course, we had the financial collapse. And I'm not saying that's going to happen this time around at all, but the cycle is the cycle. And the leading indicators are the leading indicators, but nothing I'm saying, including your questions, even about the stock market, which we can get into. What is the stock market telling you? Nothing has surprised me right now. Recessions do take time to unfold. But the thing is that nobody believes it until you get several months of employment declining. Then they say, okay, now I see. Now, by the time the employment's declining, employment's always last man standing because the hours worked lead that. The key is to stay ahead of the herd. So waiting for employment to go down is one of the craziest and dangerous notions I've ever heard. By the time employment goes down, we're going to already be 3 to 6 months knee deep in the recession. And that's the last man standing. But the hours worked are telling you that that is going to be the next chapter of the story. Now, with all due respect, do I know for a fact, is it going to be a June story, a July story, August story? take your pick, probably sometime in that time frame. And then when employment starts to go down, you see the first time employment goes down, people say it's a one-off. It's a one-off. Because you see, nobody wants to call. You see, I say to people, we're going to have a recession. And I've been through probably 4 cycles. And every time it's the same thing. I look them in the eye and I say, I think we're going to have a recession. And the response I get is as if it's as if I said your kid is ugly. It's like, no, just, it's part of the business cycle. You think that there's a get out of jail free card after the most pernicious Fed tightening cycle since 1981? You really think interest rates don't matter? It's as you said, Adam, it's that there's lags, and the lags could be 1 or 2 years, right? I mean, the Fed stopped tightening in the summer of 2006. Oh, by the spring of 07, okay, so we lost New Century Financial. We got these problems with the ABX indices in the mortgage market. Don't worry. No. Yeah, the recession started at the end of 07. It's like the Fed stopped tightening in when? Fed stopped tightening in the spring of 2000. Yeah, the NASDAQ's rolling over, but big deal. The S&P hit its high in September of 2000. Don't worry about it. Don't worry about it. And then we go into early 01. Don't worry about it. And then all of a sudden, when does the recession start? In March of 01. And I'll tell you, the consensus didn't get it, but Alan Greenspan, I'll tip my hat, started cutting rates 50 basis points on the first trading day of the year in 2001. This is where maybe a little too much information, but it's very valuable, okay?
Go for it.
That nobody, when the consensus started calling for the recession in 01? Do you know when the consensus?
After
9/11. It already started in March of 01. And of course, it ended 2 months after 9/11 because we had all those gobs of fiscal stimulus coming in after the terrorist attacks. So I know you're saying this market's saying that, and this data's saying that, but the key in this business is to stay ahead of the curve and do not follow the herd.